In the previous Macro Watch video, we saw that the Fed is tightening monetary policy much more aggressively in the current tightening cycle than during the previous one. But despite this, asset prices have fallen less than would have been expected. Home prices are only 3% below their peak. The S&P 500 index was down only 15% when that video was published, and down just 20% now. This video will explain why monetary policy is likely to tighten significantly more during the first half of next year, and perhaps beyond the first half. It will also show why investors should expect substantially more wealth to be destroyed before this tightening cycle ends. On November 30th, Fed Chair Jerome Powell gave a speech at the Brookings Institution entitled "Inflation and the Labor Market." It clearly explains the Fed's thinking about the forces driving inflation and the Fed's planned approach to bring inflation back down to its 2% inflation target. Everyone should watch it. Here's the link. Powell indicated that the Fed was likely to slow the pace of rate hikes to 50 basis points at its then upcoming FOMC meeting on December 13th and 14th, which it subsequently did. Other than that, however, his message was generally hawkish. His presentation included this chart showing headline and core PCE inflation. These are the inflation gauges the Fed watches most closely. Powell pointed out that core PCE inflation is very high and that the Fed had not yet managed to bring it back down since it's hovered around 5% all year. His presentation also included this chart. It shows core goods inflation in red, housing services inflation in light blue, and core services inflation, less housing, in green. He pointed out that core goods inflation had come down significantly from its peak as supply chain bottlenecks had begun to clear. But he pointed out that housing services inflation in light blue is rising very sharply, and said that it was unlikely to come down until the second half of next year.